Welcome to episode 2176 and greetings from a river cruise somewhere in Germany. We are on our way to Germany, our first port of call here after leaving Amsterdam, and it is 62 degrees Fahrenheit. So it's chilly out here on the deck if you are looking at me. And I must say one more thing. If you are watching on video, you're probably asking, what is this weird fuzzy thing Jason has on his neck? Is that a new necklace? No, it's not. For those of you in the sound world, knowing how to do audio production and so forth, you'll know that this is a dead cat microphone screen that helps block out the wind. So dead cat. I don't know. That's just not politically correct. But anyway, that's what they call it. So here we go. We got a couple great things to talk about today. Let's first talk about the labor market. You know, remember when I shared with you a quote from that book, When the Boomers Bail? When the Boomers Bail, I shared with you a quote from the author who said, if you talk to a business owner, tell them that everybody they will hire in the next 25 years has already been born. And that speaks to the incredible scarcity we have in the labor market. This is not only a US phenomenon, but it is a worldwide phenomenon in so many markets around the world. You know, being on this river cruise, I was on the same cruise line on another river cruise on a different river exactly 1 year ago, pretty much 1 year ago, today almost. And I have noticed that they are cutting down on staff. Now, they're hiring a lot of foreign workers that are not very expensive to hire, but even they are cutting down on staff. When I was on our celebrity cruise that we hosted just about, 2 months ago or so, and then on the real estate guys, also celebrity cruise, and then on that cruise in Europe, same brand, same cruise line, 1 year before, I noticed that the staff is getting scarcer. And I talked to the workers and they said, yeah, the housekeepers are now in charge of more rooms than they used to. It used to be 12 rooms, now it's 16 rooms. So they're just working everybody harder because of this labor shortage and because, of course, these companies are trying to get maximum efficiency. But what does this mean? What does it mean to you as a real estate investor? What does it mean to your tenants? We've got to think about what it means to them. And what does it mean about inflation? Well, it means that inflation is going to be with us for a long time, in my opinion. It's going to be the new normal. Wages are going up, and that means rents are going to go up because the wages create inflation, and wage inflation is a very, very sticky type of inflation. It's one that will last a long time. So very important as we see this labor shortage. The chart on the screen shows available US workers relative to demand, and you can see that there is a 2.6 million worker shortage. We always talk about the housing shortage, but we also have to look at the labor shortage. Now, how are companies going to solve this problem? Well, of course, they're going to try and do it with technology, and they're going to succeed to some extent. And we've all talked a lot about artificial intelligence, AI, what does it mean? But it doesn't deliver everything. The robotics component is particularly complicated. We've seen robotics that are supposedly so advanced, find it very difficult to do the most basic things, And look at this interesting statistic. McKinsey found that the number of open jobs per available worker in the US increased more than 7 times between 2010 and 2023 in a 13-year period. So this labor shortage is very, very significant. It's going to be with us for a very long time. Intriguingly, this tight labor markets mean workers can demand higher wages, particularly in sectors like healthcare, construction, leisure, and hospitality, where shortages are most acute. We've talked a lot about the construction sector, how the average construction worker is about 50 years old nowadays. So particularly home building, home prices getting more and more expensive. And if we have time today, we're going to talk a little bit about insurance and how that relates to construction costs. So again, what does this mean to us? It just means sticky inflation And we love inflation in so many ways because we get to take advantage of inflation-induced debt destruction. We've got the world's best hedge with the packaged commodities investments that we have, the natural ingredients to our properties, and it's just going to benefit us. Okay. By the way, be sure to join us the second Wednesday of every month for our monthly Zoom meeting where you can participate and get your questions answered. It is an interactive meeting, and this month we are talking about the Alabama market, several Alabama cities that offer great investment opportunities. As many of you know, Florida prices have gone up quite a bit, and that market is retrenching a bit now. So Alabama is really what we like at the moment. These things are dynamic. They always change. We are area agnostic, so we recommend the markets that make sense at any given time. For our prior clients who have properties that are stabilized in the markets we're not recommending at the moment, they're great. The thing they should do is just enjoy their fantastic return on investment. But the focus at the moment is on the Alabama market when you're looking at the southeastern United States. Of course, we have other markets. Of course, we have Tennessee, we have Arkansas, and then up in the more northern markets, we have Indiana offering some great opportunities as well. But this month's Zoom meeting will be a deep dive into several Alabama cities, and we look forward to seeing you there. You can always register every month for those at jasonhartman.com/Wednesday, jasonhartman.com/Wednesday, second Wednesday of every month. Save the date, make it a recurring appointment on your calendar every single month, second Wednesday of the month. Okay, let's talk about insurance. Now, you have all read the news, or maybe you have received your own insurance bill, and these bills have shocked you a bit. So the first thing I want to say is don't panic. Remember, your properties, just like any corporation, they are pass-through entities. What happens when they raise the minimum wage? What happens when expenses go up? The companies simply raise their prices. This is Economics 101. It's extremely simple. It's not rocket science. So when the costs go up for a company or a landlord or an investor or anybody, they simply raise prices for the consumer. That's what always happens. These are pass-through entities, just like a company, just like a business. It happens every time, every place, everywhere. So that's the first thing to understand, that your rental properties, just like a business, because they are a business, are pass-through entities. So this is going to push rents up. However, the thing you also need to realize is that it's not nearly as significant as it seems. Okay, so let's look at the actual insurance increases. How much has homeowners insurance increased in some different markets around the US? Well, nationally, all over the US, the prices are up about 11.3%, and they've been going up for many years. Now, insurance companies are always, I'll say, socializing the cost of insurance. They look at their risk pool and they look at all of the homes in their risk pool, and they socialize the cost of the insurance claims amongst all of their customers, all of their insured. Of course they do that. We understand how insurance works. However, one of the things you have to realize, and I'll use Florida or any hurricane-affected area as an example, because in my home state of Florida and in all of the Gulf states, any place that's affected by any sort of natural disaster, especially hurricanes, you've got to realize that the stuff you read about these massive insurance rate hikes really are the older homes that are not built to the new codes. So when you've got these much, much older homes that interestingly have been standing for 50 or 75 years, right? They are the ones where you've seen these massive, massive increases. You're going to be surprised. And if you're watching on video, you see the chart. You can just pick a state and you can look at this chart and see where the prices are up and where they're, and by how much. So Texas is the worst in the country. Their insurance prices went up by 23.3%, 23.3. Now, Arizona and Utah, you wouldn't think their insurance would go up because these are two areas that really aren't affected too much. I mean, yeah, you have some forest fires in Utah. Arizona, you really don't have anything in terms of insurance claims too often. Arizona's second, 21.8% increase. Utah, 20.3%. Illinois, 18.5%. And we go down the list, US average nationally, 11.3%. But guess what? Everybody thinks Florida has got such a big problem. Their prices only up 4.9%. Now, you might be asking, well, Jason, didn't they already increase the rates in Florida? And that's why that increase isn't so bad. Well, you are partially right. Because over the years, if we look back in Florida, a very much affected area, we look 2018, 2019, 2020, 21, 22, and 23, we had the biggest price increase year over year was 10.9%, still far from the worst nationwide. And last year, it was up 9.6%. And then this year, 4.9%. Or I should say 22 to 23, just correcting myself there. So again, when you have the newer homes built to the new hurricane standards with impact windows, with block construction, the prices of insurance haven't really increased very much for those. Where you've seen these massive increases that you hear about in the media and read in the media, those are the older homes that aren't built to the new codes, and they are much more susceptible to big claims, as we know. My personal residence in Florida, built to the new construction standards, a 2018 build, okay, really did not see huge insurance price increases over the 6 years that I lived there. So again, you've got to really peel back the layers of the onion and understand what is truly happening here and really examine it. But also understand, of course, all this is just a pass-through entity. You're going to pass this cost on to your tenants, as every landlord will, as costs increase, whether they be for insurance, property taxes, maintenance costs, whatever it is. Every investor makes that decision. Should I continue being an investor? Or should I sell this property to somebody else? And if they say, well, I'm going to continue, they're going to raise prices and pass them through to the tenants. Let's take a look at what this says, because there's some pretty good commentary from our friends at Resi Club here about this insurance issue. It says, while insurers are already pushing state insurance commissions for bigger increases in 2025, some experts in the space believe that the biggest shock from the inflationary run has already worked through the insurance market. This is going to surprise some of you. Check this out. Quote, there has been significant rate softening within the past 4 months, with more capital coming into the insurance market. Natural catastrophe business within the insurance almost works like a commodity. Once everyone feels prices are high enough, companies start dumping capital into insurance markets until prices soften and or a hurricane or large catastrophic event happens. Unless there is a significant event in the US this storm season, which is definitely possible, I would expect to see lower premiums for apartment owners, REITs, those are real estate investment trusts who commonly own big apartment portfolios, and in general, most real estate portfolios. But I do think about 3 or 4 months ago was the top of the business cycle when it comes to commercial insurance rates. Now, this all sort of passes through the residential industry too. It's all kind of one and the same, right? And you will see policy premiums fall with new domestic and international capacity in the marketplace. Once larger scale commercial falls off, I do think you will begin to see the residential insurance piece begin to fall off. An underwriter in the E&S property space who'd prefer to remain anonymous told Resi Club this week. So folks, this insurance thing is not nearly as big a deal as people are making it out to be. If you have a newer property, you haven't seen your premiums go up that much. Of course, they do go up a bit, even if you don't have claims, because it is socialism. Essentially, that's how insurance works. But again, the price increases really aren't that bad unless you have much older properties that are not built to the new codes. All right, we are going to make this a topic of one of our upcoming Empowered Investor Pro calls. If you're not a member of Empowered Investor Pro, well, you need to have your head examined because it's going to cost you so much money not to be a member and not to get the inside scoop and all of the resources we offer with Empowered Investor Pro. But some of this you can take advantage of on our monthly Zoom calls, which are open to everybody. Be sure to register for the next one at jasonhartman.com/Wednesday, and we'll look forward to seeing you there. Happy investing.